Hi, everybody. Just wanted to share with you. We just recently had a conversation with the Chief Economist at BCREA, Brennan Ogmundson. I believe that's how you say his name. And he had about a 40-minute presentation to our office. And, everybody wants to know, will interest rates drop this year and when they're going to drop? I have a huge amount of buyers that are waiting to do that. And he basically told us what are the biggest indicators that the government is going to kind of look for if and when they do drop rates. And I'll just kind of let him kind of tell it. And at the end of it, I'll kind of tell you my synopsis of the whole thing. I hope you enjoy this. This was very illuminating for me, and I hope you guys get a lot of benefit from it. Again, as always, my name is Hani Faraj, Vancouver House Finders. If you're looking to buy this year, looking to sell, and you want to make sure that you don't buy and sell, buy without selling and sell without buying, talk to me. We'd love to help you out. But enjoy this conversation. It's very illuminating. Take care.
Okay, everyone can see my slides, I assume. We'll get going. I probably have too many slides, but let's see how fast we can do this. So when we talk about the outlook for the economy in BC and in Canada, we're kind of in a place where no one really expected. So if you had asked in 2000, most economists, like 2022, what would happen in 2023, there was almost total consensus that we would have a recession in 2023 because central banks everywhere were tightening very aggressively. So raising interest rates very aggressively, that tends to generally lead to a recession. We had all kinds of indicators like the yield curve had inverted, and that usually is a good sign we're going to have a recession. And yet, so far through 2023 and into the first quarter of 2024, no signs of a recession yet. And this is really, really unusual. Normally, when we have a big spike in inflation, and when I say normally, I mean sort of like over the past 100 years, when we've had a real spike in inflation. So that the blue line in this chart is inflation. All those orange bars are Canadian recessions. You can see when we have inflation that's really high, it tends to mean or take a recession to bring it back down to normal. And that tends to happen because the central bank raises rates very aggressively. This time around, we peaked at 8.1% inflation in 2022 at an unemployment rate that at the time was an all-time low of 4.9%. We've more than cut that inflation in half without too much of a cost in terms of output, lost output or lost jobs. We do have especially the jobs data that came out on Friday was a little concerning because that unemployment rate ticked up to 6.1% in Canada, the highest it's been in 3 years. It had been about 5.8%, 5.7, kind of trending the last few months. So maybe some cause for some concern with the most recent unemployment numbers, but generally, thus far, we haven't had much of an impact on the economy from high rates. While we haven't seen a recession, we're certainly not seeing strong economic growth. So not a recession, but not great. Especially when we look at a bunch of different measures of how the economy is doing. The one that we measure kind of things by all the time, real GDP, has been either kind of slightly negative or very flat for the past few quarters. Interestingly, in the first quarter of this year, we're actually tracking like 2.5 to 3% growth, which would be the highest in quite some time. And then measures that get talked about a lot, like GDP per capita. So how much output are we producing per person in Canada? That's been very negative and falling for a while. A lot of concern about that. If you read the financial media, that might be slightly positive in the first quarter as well because population growth slowed slightly. But it really, across a bunch of different measures, the Canadian economy appears a little bit sickly. That's kind of true in BC as well, where we had, of course, a huge rebound in growth. If you're not familiar, this is our nowcast, which we track how the BC economy is doing, and as close to real time as the data allows. So the most recent estimates for February. You can find this on our website if this kind of thing really interests you. But yeah, it tends to track the economic growth in BC really closely. We had a strong rebound, of course, in the pandemic. We had really strong growth in 2022. And then as interest rates hit, things started to really slow down, but never went negative. So we were tracking economic growth in the province at like 1 to 1.5% in 2023, and kind of handed off to 2024 at a similar rate. So the economy is a little bit weak. Inflation's coming down, but there are some real risks on the horizon, particularly when it comes to the impact on the housing market and on consumer spending in Canada from mortgage renewals. So you all probably have clients or know people, or perhaps you yourself got a mortgage in 2021 at sub 2% rate or sub 5-year fixed rate or something. And you're about to get reset. Maybe it was a 3-year term or a 5-year term. So there's a lot of those resets coming at much higher payments. The Bank of Canada has put together some data on this about what share of mortgages are going to be up for renewal that had originated in 2021. And you can see, over the next 5 years, we're going to see a significant amount of those mortgages get reset at higher payments. We've already, according to this data, gone through 40 to 50% of those resets. A lot of them still to come, and a lot of the fixed rate mortgages are about to reset this year and next. We've seen, of course, a lot of people that if you had a variable rate mortgage with a variable payment, my condolences. The last couple of years have been pretty rough, but 40, 50% increase in your payment. People with a variable rate and a fixed payment too have seen get reset because of hitting trigger rates, had to make lump sum payments or increase the payments. So a lot of this we've seen already. The really good news, I think, this is a major risk for the economy, because if people get reset at a 30 or 40% higher mortgage payment, they're going to probably slow down their consumption spending, or at worst might have to sell their home because they just can't afford the payment. The good news is that we've been through a significant amount of these resets already with variable rate holders, and we haven't really seen a lot of signs of financial distress. So we look at a bunch of indicators of vulnerability of households, particularly looking at falling behind on loan payments for 2 months. At the national level, we're not really seeing an uptick, whether it's in auto loans or credit cards or HELOCs or mortgages. Not seeing a large increase in the arrears rate on those products. And then in BC in particular, things like mortgage arrears are 0.14%. So this is a 90-day measure. So households who haven't made a payment on their mortgage in 3 months, that's at 0.14% of all mortgages. A few months ago it was 0.1, so it's slightly up, but still very, very low. It kind of peaked in 2012 at about 0.5%. And then consumer bankruptcies are very low as well. So despite the fact that we're seeing higher costs of living, higher interest rates, we're not yet seeing much of an impact on household finances themselves. One of the reasons why is that the labor market has actually been really strong through all of this. So kind of surprisingly, given normally when rates rise as much as they have, you tend to see a real uptick in the unemployment rate. Instead, we've had a minor kind of rise in unemployment rate, certainly still much lower than it was during the pandemic, and wage growth is really high. So there's been a lot of competition for available labor in all across Canada. If you have a low unemployment rate, lots of job openings like we had the last couple of years, you're going to have a lot of competition for the labor supply that's available. That drives up wages. So we're seeing wage growth in BC and Canada. Canada like 5-6%. BC is like 8% wage growth year over year. So really, really strong increases in wages. Even if you take out 3% inflation, we're still talking about 5% real gains in terms of wages. So we have the situation where the labor market's in okay shape. Wages are growing really strong, but people aren't spending money. So when we track consumer spending in BC using things like retail sales and that kind of thing, it's pretty low. It's not like recession low, but we're tracking consumer spending, which is about 2/3 of the economy. So it's the engine of growth essentially in the economy, and it's at like 2018, 2019 levels. Normally, households are spending on the order of like 3% growth per year, and we're tracking that sub 2%. So very, very weak spending across households. A bit of a conundrum for people that forecast the economy and track these sorts of things. why, given fairly strong labor market fundamentals, are households just not spending money? They just seem to want to save. So for whatever reason, the pandemic completely changed savings behavior across Canada. The decade before the pandemic started, the savings rate in Canada started off at about 5% and declined for about 10 years, was basically zero in Canada from like 2016 to 2020. Then the pandemic hits. It's like a forced savings program for a lot of households. The economy built up about $300 billion in excess savings. But even in 2022 and 2023, households were still saving. We weren't seeing massive drawdowns of that massive buildup in savings. Even the last few quarters, we're tracking savings, household savings at like 5-6%. So for whatever reason, households are looking at the future and thinking, and being kind of cautious. Maybe it's those mortgage renewals. Maybe it's just generally a lower appetite for risk. Whatever it is, households are saving a lot more than they used to. As a result, if you're saving, you're not spending. We are probably going to see economic growth this year come in pretty similar to 2023 at around like a 1% rate. So again, not a recession, but pretty slow, though we do expect things to recover next year as rates come down, and maybe that'll start to propel the economy forward. All right. What about inflation? I'm hoping one day I will have a presentation where there's not like 6 slides about inflation. But for now, we do have to continue to talk about it. And is this sort of period of elevated inflation over? I think so. I think we're going to see inflation come down significantly still this year for a few reasons. One is that the way monetary policy affects the economy is that rates go up, and about 6 to 8 quarters later, the peak impact on inflation is felt. So it takes a very long time for monetary policy to work its way through the economy. If you kind of recall, the Bank of Canada raised rates by 200 basis points between the summer and the end of 2022. So those really big rate hikes are about to have their peak impact on the economy, kind of in like the first quarter of 2024. You can see with the blue line here, we've traced out the impact so far. Should update this for Q1. So we're getting to sort of the peak impact of how much of a drag on inflation those rate impacts will have. The other thing is that labor markets are normalizing. So we talked about wage growth being really high because of all that competition for the available labor. Way back in 2022, 2023, we had about 1 million job openings in Canada. We had 170,000 job openings in BC. So jobs that people were looking to fill and just couldn't find workers to fill. As a result, because if you have a low unemployment rate, lots of job openings, you're going to have competition for available workers. People were changing jobs and getting like 10% wage increases. That tends to feed through to inflation. So when wage costs are very high and productivity is low, a lot of that ends up getting passed through to prices. And as a result, you're driving inflation a bit higher. Job vacancies are way down. Maybe demand's a little bit lower, so maybe those jobs have been pulled from being offered. Maybe they've been filled by strong population growth. Either way, there's just a lot less tightness in labor markets, and that means wage growth should come down. There's a very strong correlation between inflation and sort of how tight labor markets are. As markets get a lot less tight, inflation is going to fall. That's exactly what we've been seeing, especially in like most recent measures of inflation. If we kind of compare what prices are today versus 3 months ago and annualize it, it's a really good kind of sense of the direction of inflation or what the trend in inflation is. And with that measure, we've been seeing core inflation, so stripping out the most volatile prices, food and energy prices, taxes. We've been seeing core inflation trending at like 2%. So the old measure the Bank of Canada used to follow, CPI ex food and energy, is actually below 2%. Their new measures, CPI trim and median, these are what the Bank of Canada watches the most closely. So when CPI comes out, a good idea to see what CPI trim and median is doing. Those are tracking about 2% on a 3-month basis as well. Moreover, we tend to have been surprised by inflation the last few months. If you look at what the Bank of Canada was forecasting last year, our own forecast model from last year, and what inflation's actually doing, it's actually surprised a little bit to the downside over the last few months. So we're tracking below forecast for inflation. So we've actually made a lot of progress on inflation already, and good reason to believe we'll keep making that progress. Then, of course, I think the big thing for whether or not the Bank of Canada is going to lower rates is really, where is that inflation coming from? So it's really important, I think, to strip out parts of inflation the Bank of Canada either can't control, like rents, or parts where their own rate increases are actually feeding inflation, like mortgage costs. So if we take those two things out on a 3-month annualized basis, inflation's either negative or zero. So if you take out all shelter costs over the last 3 months, we're actually running at a negative 1.2% inflation rate. So actually deflation over 3 months if you just strip out shelter costs. You can kind of see this on a 12-month basis as well. If you take out shelter, we're tracking about 1.4% year over year. Shelter costs are still rising really fast, like 6-7% in Canada, higher in BC, but it's for a couple of factors. One, mortgage interest rate costs are very high. They're like 30% higher year over year because of the Bank of Canada's own tightening, which tends to drive mortgage rates higher. So that clearly raising rates further is not going to help that type of inflation. And the other side is rent. Rents are currently rising at a very strong clip because we don't have enough rental supply, and federal policy on immigration is putting a lot of pressure on rental demand. So, students and temporary foreign workers, especially non-permanent residents, tend to be renters in big cities, and that's going to drive rents higher if the market can't absorb that demand. So if most inflation is coming from things the Bank of Canada can't really control, or that they're actually sort of driving inflation higher with keeping rates where they're at, good reason to think that the Bank of Canada is going to look through that type of inflation when setting policy. Especially when you look at there's going to be some deflationary impacts on the rental market because of a pretty dramatic swing in federal policy on immigration. So last week, I think it was, the federal government announced they would like to bring the share of non-permanent residents, so again, mostly students and temporary foreign workers, down from its current level, about 6.5% of the population, to about 5% by 2027. So that's a swing from a net inflow of like 800,000 people in 2023 to we're going to have a negative, an outflow of non-permanent residents, about 150,000 outflow per year over 3 years. So that's like a million person swing in population. That's going to have an effect on the rental market. It's going to take some pressure off the rental market for sure over the next few years. So a lot of the job on bringing rents down is going to be done by federal policy. So what does that mean for the Bank of Canada? Are they going to cut? Are they going to cut this week? Probably not. But what does it mean for the rest of the year in terms of the Bank of Canada? If you look at their most recent forecast, which was January, they were forecasting that we would have about 0.8% growth in 2024 and decent 2.5% growth essentially in 2025, with inflation coming back to about 2% quarter over quarter by 2025. When I saw that forecast, I thought that looks a lot like our forecast. So our model, which is similar, all models in forecasting are basically interest rate driven. So everything, inflation and growth is really driven by what the central bank does in all these models. So if we have a similar forecast, and our models are pretty similar in what's driving that forecast, we could probably uncover what the Bank of Canada is thinking about setting policy. So they're not going to tell you what the path of interest rates is that generates their forecast, but we can, because if our forecast is similar, our models are similar, we should have a similar rate path. So you can kind of see what that looks like in the top right corner. We just kind of zero in on it, make it zoom in a little bit on just the rate forecast. You can see that, a path that looks like a rate cut in the third quarter, 100 basis points of cuts this year, bringing rates down below that 3% kind of threshold for where the Bank of Canada wants rates to be by the end of 2025 is about in line with probably what they're thinking. That shaded areas with the Bank of Canada calls their neutral range. Essentially, that's just where they want interest rates to be long term. So they would really like their policy rate to be between 2 and 3%. So we kind of know where they're going. It's just a matter of how fast we're going to get there. If you ask financial markets right now, they were a little less aggressive than our forecast. They started the year very aggressive. So I think at the start of this year, financial markets were pricing in like 6 rate cuts. That was probably too much. Right now, they're pricing only about 3 rate cuts. We'll see where we end up. Probabilities right now, 88% chance the bank cuts in June by 25 basis points, 96% chance of 50 basis points of cuts by September, and 100%, so near certainty. That's how you know not to take these probabilities too seriously whenever you see 100% certainty in anything in financial markets. But a lot of expectation that we'll have 75 basis points of cuts by the end of this year. You can see how those expectations are translated into 5-year mortgage rates. 5-year mortgage rates always move before the Bank of Canada does anything. They move entirely based on expectations about the Bank of Canada. And those expectations change pretty dramatically at the end of 2023. You can see in like November of 2023, we had a 5-year fixed rate that was like 6%, a little over 6%. Now it's at 5.09. So we've already seen about 100 basis points out of 5-year fixed rates without the Bank of Canada doing anything. We've even seen variable rates come down a little bit because discounts are a little more generous. So right now, where 5-year fixed rates are at is about where they should be. They're kind of priced with a spread, so 5-year bond, 5-year fixed rate minus 5-year bond yields. That spread is usually around 160 basis points. That's around where we are right now. So where the 5-year fixed rate is right now is probably where it's going to stay unless we get like another 30 basis point cut or so in 5-year bond yields, which is kind of where they would end up settling long term. Once the Bank of Canada is done cutting, how much more rate relief should we expect on 5-year fixed rates? So 5-year fixed rates already are at 5.09, which is basically what we forecast them to be by the end of this year. Got there really fast. Where might they settle? How much lower are they going to go? Well, we can kind of estimate where 5-year fixed rates are going to settle if we just look at historical spread, so the difference between government bond yields and the overnight rate, mortgage rates and the overnight rate. We kind of build up, you kind of bottom up from the Bank of Canada's overnight rate to a 5-year fixed rate. By the time the Bank of Canada cuts to say 2.5%, that implies a 5-year fixed rate that's like 4.85. So not a lot further than where we're at right now. We're already at 5.09. If we're going to settle at like 4.85, there's not much more room for 5-year fixed rates to fall. That's a lot higher than what we've experienced over the past 10 years. So the average 5-year fixed rate over the last 10 years was like 3%. We've had a lot of crises in that period. We're probably not going to see rates like that anytime soon. And so a much, much different mortgage rate environment than I think probably any of your clients have grown accustomed to, and certainly much higher for first-time home buyers in the coming years. All right, so given that path of interest rates and given what we expect for the economy, what is the most likely path for home prices across BC? To talk about that, we need to talk about supply and demand. As always, on the demand side, if we just look at like sales per capita as a proxy for pent-up demand, there's a lot of pent-up demand, a lot of demand on the sidelines right now. We have all across BC and Vancouver, huge population growth and pretty slow sales. So there's a lot of potential buyers just waiting. What are they waiting for? Probably the Bank of Canada. So even though mortgage rates are down, I keep trying to get this point across and failing. Mortgage rates are already pricing in like 200 basis points of rate cuts. They're already in the 5-year fixed rate. No need to wait. But it seems like psychologically, perhaps buyers just maybe they're gun shy based on last year. Generally, we get really strong reactions in the resale market to just changes in expectations about what the Bank of Canada is going to do, or their own actions. So we talked about long lags between monetary policy and the wider economy. With the resale market, things are usually pretty instantaneous. You saw once the Bank of Canada started tightening, sales fell to like 30-40% below normal. As soon as the Bank of Canada last year in January said they were on pause, we saw sales surge back to basically normal levels. Then they were like, whoops, actually, we're going to raise rates again in June and July. And we saw sales fall back down at the end of the year to about 30% below normal. And that's around where we are as of February. March was also pretty weak in Vancouver. March sales were at like a 22,000 annual pace. I think it was 2,400 sales total, which is a really, really weak March. I checked April data this morning. Looking pretty good in Vancouver, actually. Pretty strong start to the month for April. It's only been 5 business days, but a pretty good start. So what does that mean for the forecast? Obviously, because in BC and Vancouver, we had, I think, our weakest sales since 2012. I think sales are going to be better this year. We did have a very weak first quarter in Vancouver, but I think things are going to pick up in April. We're already starting to see signs of that. So, our BC forecast is largely driven by what happens in Vancouver because it's such a large share of sales. So this is basically the profile that we're expecting. We were expecting a kind of a weak first quarter, a weak first half that would hand off to a pretty strong second half, into a really strong 2025. So that's basically our expectation. We're more or less following that so far, especially if April really picks up the way we expect. I think that sales will be pretty decent. So in Vancouver, that means this year, I think our forecast is like 28,000 sales, which isn't great. It was 24,000 last year, which is really bad. And about 33,000 sales in 2025. So I do think things are getting back to normal. We'll have much stronger sales. In terms of home prices, what happens with prices really depends on what happens with listings. Right now, prices have been pretty flat for the last 6 to 8 months. In Vancouver, prices just didn't fall that much. We had markets like the Fraser Valley where prices fell like 25% from where they peaked. In Vancouver, maybe they're down like 5-10%. And last month in March, the average price was like 1.3 million, so it was still really, really high. So prices have been pretty flat. We've started to see in some markets over the last few months prices inch up. So what happens from here really depends on listings. Last year was the weakest year in Vancouver for new listings since 2003. Just people were not in the mood to list their homes. Some of that, I think, this is a big issue in the United States, is this idea of a lock-in effect, where if you had a very high rate, if you had a very low mortgage rate that you took out in 2021, and you'd like to move, but doing so means getting a new mortgage at like 6%. That was depressing, I think, potential selling activity. As rates come down, that should be less and less of an impact. So generally, like that will start to cause new listings to come up a bit back to normal. Just generally, if we've got a lot of demand in the market, people are out looking to buy. They're usually looking to sell as well. So just overall activity in the market should help listings pick up. If we can kind of keep sales and listings basically imbalanced the way they are now, we shouldn't see prices move very much. I think our forecast for prices this year is essentially like a 1% increase in prices in Vancouver. Again, they didn't really fall that much. If you look at the distance from peak average price across the province, Vancouver is down at this point at the end of 2023. They were down like 5% or less, I think like 3%. That's a lot different than any other market. So maybe less room for prices to really move in Vancouver, especially at the higher ends. If we see listings not keeping up with prices, then maybe we're going to start with sales rather. If strong rebound in sales and new listings are very low, then we could see some extra pressure on prices. But again, Vancouver's got probably the least room for prices to move. Affordability, as everyone on this call knows, is already pretty stretched in Vancouver. All right, so that's kind of the outlook. I'm going to speed through some stuff about housing policy as sort of the good, the bad, and the ugly of provincial housing policy, federal housing policy, municipal housing policy. I'm going to start with the ugly. And the ugly of housing policy is really just what's happened to affordability over the past 10 years, and the policy that we've implemented to try and control affordability has completely failed. I think it's fair to say. So we know that demand can change things very quickly. Demand changes essentially overnight and impacts prices very quickly, especially if supply can't keep up. And that's what happened during the pandemic. Essentially, if you just look at like a benchmark mortgage payment from 2019 to 2023, every market saw that mortgage payment essentially double in a very short period of time. Even in Vancouver, where affordability was already stretched, saw that mortgage payment rise by like a third, which is a lot. It's just not 96% like in some markets that used to be affordable. Whenever we talk about affordability, I think you naturally get into issues, intergenerational issues about who actually had it worse in terms of affordability. This is generally millennials arguing with baby boomers because baby boomers have this very deep scar tissue where if you ask them or if you basically mention mortgage rates or mention that rates are rising or rates are, if you say hi, they get very upset. Within 0.5 seconds, if you talk to anyone over 60 about mortgage rates, they will bring up their first mortgage that was 18%, which is true. If you look at mortgage rates when each generation was in the housing market, so age 25 to 40, you can see why that scar tissue is there. Highest mortgage rate, 21.5%, average of 12% over that period. So clearly affordability was really bad in the early 80s. The argument that millennials and Gen Z have on their side is that they're one of the first generations to see, to expect rates to increase rather than fall. We've had about a 40-year decline in mortgage rates. This is the first generation to see like a sustained rise in mortgage rates. And the first where we have to deal with a stress test where we're capped at like a 5.25% a minimum qualifying rate, and it's going to be even higher than that if rates settle like 4.5% to 5%. Not only that, for young people right now, this is even accounting for those very, very high mortgage rates back in the 80s. Getting into the market and affording a home right now, if you're 25 to 34, it's never been more difficult. So if you look at a proportion, a mortgage payment is a proportion of a dual income 25 to 34-year-old household, we've never seen affordability this bad. So even accounting for those 21% rates. So affordability is clearly very, very challenging. And one of the reasons why is we've been trying to deal with affordability by sort of a relentless pursuit of lowering demand from places where demand just isn't that high. So whether it's foreign buyers taxes, or money laundering investigations, or foreign buyer bans, or flipping taxes, or whatever it is, that combined with a real tightening on mortgage regulations, the stress test, and minimum qualifying rate, all of those things, all of these policies on the screen directed at helping affordability. This is what's happened over that period. We saw home prices double. So the probably the best that you can say about housing policy over the past 10 years is that maybe without those changes and all those taxes and all those changes to regulation, maybe prices would be even higher. I don't know. That's the best counterfactual. It's very hard to argue that they've had a material positive impact on the market and on affordability. And it's not just on the ownership side. The rental market is also a complete disaster. We kind of measure a benchmark. Healthy vacancy rate is 3%. We weren't there in 2010 in Vancouver. We're certainly not close to there as of 2022, and we've got good data. And rents across all major markets are up like 60 to 80%. So not only is the ownership market very difficult for young people, it's really hard to even get into the rental market. All right. What about the ugly of housing policy, or sorry, the bad of housing policy, rather? I will just briefly flip through the flipping tax. It's not ugly. It's not really going to have much of an impact. It's just kind of bad policy that has the potential for downside consequences. If we look at the share of homes that are purchased and sold within 1 year, I know the flipping tax is 2 years, but we don't have data really on 2 years. 1 year is about 3%. 6 months is about 1.5% in Vancouver. The province says within 2 years is about 7%. But most of the people that are buying and selling within 2 years are going to meet some exemption criteria for the flipping tax. You know, either changing jobs, changing household size, whatever it is. You know, renovating a home and putting it back on the market with a basement suite or something. There's going to be most of those transactions are going to be exempted. As a result, the demand impact is very small. In our simulations, you know, the share of sales that with 2 years falls from like 11% down to 10%, so about a 1% decline in sales, and the impact on price is about 0.1%. So very, very, very small impacts. The problem I have with it is because they set the flipping tax horizon at 2 years. There's a very good chance that there are some sellers that instead of selling will just delay for 8 months to a year, whatever, to avoid the tax. So you're going to get an overall decline in inventory at a time when we really, really need inventory. If that happens, we will see prices rise at a rate that's actually faster than without the tax. So you could have a situation where the effect on the market is totally counterproductive, simply because they for some reason decided that 2 years is a flip. No one thinks of a flip as 2 years, except for the provincial government. All right. Lastly, the good news is that we're finally doing supply policy. So supply is very in these days, no matter what political stripe. Everyone is talking about housing supply. And we've had all kinds of great housing supply over the last 6 months, housing supply policy over the last 6 months. You know, whether it's permitting multiplexes on single family lots, massive rezoning around transit areas, hopefully some policies designed to speed up permitting, all of the right policies, things that we've been talking about doing for like 20 years. They're finally all doing at once. If you take the government's estimates on how much supply this will generate at face value, and there's maybe reasons not to, then you can see the impact. This baseline scenario that we've simulated for prices is essentially home prices growing like 4 to 6% a year. But once you're at $1 million, that compounds really fast. If we can add the 250,000 extra units over a 10-year window over that period, then we'll start to see prices flatten out in the 2030s and affordability start to really improve in the 2030s. So the lesson kind of here, though, is it took about a year for affordability to go from like not great to really, really bad. That's that sort of vertical spike in 2021. It might take 10 to 15 years to fix it. That's why we need, we should have been doing a lot of these supply policies a lot sooner. We need a housing market that's sort of resilient to demand shocks, that has enough supply and abundance of supply to insulate us from the types of demand shocks that cause prices to really spiral. Can we build that much housing? Well, the construction workforce is currently, sorry, this is labeled very poorly. In orange is the share of the construction. Nope, I got that wrong. Blue is the share of the workforce in construction. It's currently at about 8%. It peaked at about 9.5%. If we're going to build a lot more housing, we probably need a lot more construction workers. That orange line, though, is the share of people that work in construction over the age of 55. It's more than half of the construction labor force is currently over 55, so maybe within 10 years of retiring. Clearly, we're going to have to get workers from somewhere, either from increased immigration targeted at construction workers or really incentivizing young people to join the trades workforce. The other side of it is productivity. So how much stuff we can build for that sort of hour of labor worked in construction has been falling. It's not, productivity is pretty bad across Canada. It's really bad in construction. So we're gonna need some combination of more people doing things more efficiently to have any chance of getting that done. If we can, the target is about 60,000 completions a year. We're currently, the highest we've ever done in a single year is 42,000 units. I wish I could tell you what we did in 2023. The CMHC stopped tracking provincial completions. You can only get it at the large city level. I don't know why they did that. It's very annoying. But we'll sort of know if any of these supply policies are working if we can be anywhere close to this orange line. All right, to summarize all that information very quickly. I think the economy is going to be pretty slow this year, but I think generally we'll be picking up in the second half of this year, leading to a stronger 2025. I think inflation is going to be back down to target, hopefully sooner than expected. And that should allow the Bank of Canada to cut rates, probably within the next 2 years, back down to about a 2.5% overnight rate, which implies a 5-year fixed mortgage rate somewhere around, let's call it 4.5%. That's a lot higher than it's been in the past, but certainly better than the alternative of like 6.2, where it was at the end of 2023. Prices probably flat this year unless we see new listings continue to really disappoint. So far this year, first quarter new listings look average, so that's good. They were really below average last year. So price growth probably pretty flat. And then on sort of long-term affordability, we have the right policies in place finally, but there's a lot of uncertainty around whether or not those policies are going to be enough, or we're going to be able to achieve sort of the goals that we have in terms of getting a product to the market. All right, I'm happy to take any questions.
Hey guys, so welcome back. I wanted to kind of summarize what Brendan said in his 40-minute slide deck here, but a couple of key points. Number one is nobody expected this, that the resilience of the Canadian economy was shocking to everybody. Inflation basically peaked at 8.1%, and all the different monetary policies that the government has kind of imposed has obviously affected that, and that's why our rates our rates still high kind of, and inflation is going down to below 3%. Labor market and wages has gone up year over year, so that's pretty good, and our unemployment rate is pretty strong. Housing market seems to still be stable even though all this is happening. Mortgage resets, looks like the fixed rates have come down. And the one thing that you kind of hear is that the government's target rate, and it's not in my document here, is actually 4.5. Everybody wanted these rates to go back to 2% and 1% and all that stuff, and they're on a different planet, not Earth. That's not going to happen. Also, there are some new, I don't know if you guys saw the new rate cut from OFC, where they're going to start implementing a new maximum borrowing rate. It's very important that everybody looks at that. Basically, you want to make sure that you're getting approved before these policies do come in effect, which kind of indicates that they will drop rates, but we just don't know when, so on and so forth. Again, policy impact on affordability, all the different things that the government is doing is to dampen the need, but also trying to make prices go down and without killing the market, essentially. Okay. Supply and demand, obviously the reason why we're having these issues is because we have too much demand via immigration. The supply is not enough. Future expectations. So, what Brendan kept saying is that we think we're going to get out of this in 2025, maybe 2024, 2025. Housing market forecasts is they're going to be relatively flat this year unless new listings significantly underperform. Long-term implementation of supply policies is crucial and improve affordability. So again, he thinks is that it's going to be about the same type of flat growth for the first 6 months, and then maybe if they do drop rates, that we might see a little bit of a pickup and well into 2025, and that's what's going to get us out of this. But the main point I wanted to kind of say is that it's very crucial. In the video, he talks about how the government want, like, their kind of target rate was the rates that we see now. Okay, especially when it comes to fixed. So that's where maybe variable will drop a little bit. He doesn't know. The government has said that they're going to drop it a little bit, but I don't think they keep holding and holding and holding, which kind of indicates to me that they're kind of realizing that we're not out of this mess and they don't want to create a big frenzy. Okay, so just keep that in mind. Again, I hope you enjoyed this conversation with Brendan. If you have any questions regarding the real estate market and want more in-depth analysis of your home's value, please reach out to me. Would love to help out. Again, Hani Faraj with Vancouver House Finders. Have a good day. Cheers.